There, this is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, Where Do We Investors Stand? It is Friday, January the 30th, 2026. Let's get started. Now, just a word of caution here. We're going to talk a lot about silver and gold. See up at the top of the list here, I don't think these are updated. This is probably to yesterday. Again, just a bit of a dated delay here, given that, markets are open already this morning and there's a lot going on here. Just a reminder, please pause your video player at any time to get more details, and we will get right into it. So this is the biggest bar against. Now, on the left side, these are a little bit different charts because I wanted them to be live. You can see here on the left, this is gold, and on the right, we've got silver. Now, those are large bars. Now, you've heard me refer to this before. Some of you know very well what I'm talking about, but essentially what we're trying to do as investors is gauge demand and supply. Those of you who know me well. I do not make forecasts. We don't pretend to play that game. There's all kinds of narratives that can be fun to participate in and understand. At the same time, it is demand and supply that move prices. And the bottom line is we've had a massive rally, particularly in silver. And again, it gets extended and it's completely reasonable. There's nothing wrong. And it's important to say it is not meaning that there is a massive peak that we'll never see the highs that we just saw yesterday, for example. Bottom line is silver just went to $121 or $122 yesterday and is now reversed and is trading around $100 US an ounce as I record this. Gold bullion just had the highest rate of change over the course of the last 48 periods. So again, what is 48 periods? Well, it's 48 trading days, if you will, and a 31% rally over that time period makes it the highest of this decade. Sorry, not this decade, this century, right? So we're talking, 26 years. So again, we all probably know at this point that gold and silver have been rising, and again, there's lots of enthusiasm, but remember, we want to be careful as investors. We don't want to get too enthusiastic after significant rallies, and at the same time, we obviously don't want to get pessimistic after things correct. And as humans, we are emotionally wired, and we tend to do the opposite of what we should do. So gold versus silver, you can see here, gold, again, it took a tremendous amount of sorry, let me start again here. Silver versus gold. So down here, we've got 46 ounces, roughly 50 ounces of silver to buy an ounce of gold. And up here, we were up at 100 ounces per gold. And the bottom line is you can see this range here. Again, it's just the last 30, 35 years. But the bottom line is we're just trying to gauge whether gold or silver is kind of more attractive relative to one another, just because they're both precious metals. Let's look at gold versus stocks. Now, there's a lot of information on this chart, and I want you to understand this again. So I can sit here and say, yeah, there's the biggest bar against, and we can talk about taking profits and all this kind of business. At the same time, look on the left. This is gold versus stocks. This is on the U.S. basis. I think I can make an easy case here that this is actually a new uptrend. So gold is outperforming stocks. It has been outperforming stocks on a 1, 2, 3, 4, 5, 10, and I believe 20-year time frame. And so that is very, very important because I can tell you, based on the data, based on the sentiment, most investors do not even own gold in their portfolio because, again, we tend to be biased. We're biased towards stocks. We're biased toward quote unquote balanced funds and whatnot. On the right side, we've got the Toronto stock market, which is definitely a stronger market. I think that is definitely something we want to continue to talk about. And you can see on the right side here, right now, you could sell a unit of the TSX for about 6.5 ounces of gold. Now, again, back, 10 plus 12 years ago, we could sell it for, almost twice as much. 11 ounces of gold. That means the Toronto stock market as well is not performing as well as gold. This is a downtrend. So when a bounce and a downtrend happens, we should be thinking, okay, like we want to constantly gauge risk and reward in our portfolios, and that is exactly what we do for clients. Yesterday in the gold stocks, again, there's been obviously a big rally. It's all related, right? So when I think about gold stocks, I think they're more volatile. I think that, again, investors sort of tend to either express extreme optimism and they push them higher, but they also push them down faster. That is the biggest bar against. Now, again, you can see by the selling tail there in the red candle, they came a little bit off their lows yesterday, but there was a bearish divergence. These things have come a long way, and at the same time, we just push sell because that's what we do. And again, I don't have a problem taking profits in the face of what appears to be very kind of short-term sentiment heavy with increased volatility situation, which is exactly what we've seen. Now, we've owned Kinross Gold as one name. You can, again, you like to see how I perform relative strength analysis, which I think is very important. On the left side, you can see this is Kinross versus gold. That's an uptrend. Kinross versus gold stocks. That's an uptrend. And Kinross versus S&P TSX, the Canadian stocks. That's an uptrend. So that's a relative strength across all three related assets or asset, kind of indices right here. And so again, why would I sell the red circle? Well, because, it's volatile. And so I think at this moment, I think Kinross is showing down about 10% in the pre-market. And again, we sold it to somebody yesterday and not my problem. Let's move onwards here. Commodities, I should say inflation is rising. Now, again, I know we're told that inflation is settling and we're told that it's coming down, and we're talking about, the old 2% target is now 3% and so forth. We all know prices are rising. We all know that our dollars are not buying what they used to buy. On the left side, you can see the commodity index is going out to all-time highs in Canadian dollars. On the right side, we're making 18-year highs for the commodity index. So again, no matter what the central bank or our favorite politician tells us, the bottom line is that rising input costs tend to cause rising inflation, and they can go and change the formula, they can do whatever they want to do, but we want to go and just observe the actual data instead of getting caught up in somebody's narrative. Here's stock markets by 3. You can see the Toronto stock market has been actually, for sure, very consistent, very stable. The NASDAQ has been certainly more choppy, lots more technology, of course, in there, and the S&P 500. These are just short-term charts. We're definitely in uptrends, but again, we got overbought here. We've got divergences, and so again, markets are allowed to cool off, right? There's been a very strong January for the most part, and so again, we want to be careful as investors. We don't get caught chasing things too late. Now, I've talked about this before. I'm going to talk about it again. This is ARK Innovation, the ARKK. I've got that mislabeled, and this is relative to the S&P, and I think this is a proxy for growth, right? So when growth stocks are rising, that's a very kind of bullish environment. Now, we've had definitely a shift toward value recently, which is again related to commodities and mining and energy and materials and all this kind of stuff. But the bottom line is this starts to resemble what would be called an inverse cup with handle, whereby again, we're making shoulders, we're making a high, and then we're going lower. This is a relative chart. But when ARK Innovation is starting to underperform the S&P, again, I want to be careful because it suggests some degree of caution. Earnings reactions. Now, again, we've had some volatile earnings reactions so far. KLA Corp, one of our semiconductor holdings, just reported overnight. I put a circle on there this morning. Stock was down about 10% in the pre-market. I drew the line where the stock was going to kind of, suggestively open. I think right now, before I record this, it's down about 8%. So will the chart change based on the reaction? Not necessarily. I will have to wait and see, right? But again, what are we trying to gauge? We're not trying to go and spend our time reading the earnings reports or hearing what the CEO has to say. We're trying to gauge what the market thinks, because the market is far smarter than you and I. Let's look at the Canadian dollar, breaking out of a bit of a range here. So again, last year, February, I called the Canadian dollar bottom. I said the Canadian dollar bottomed. It bottomed in the face of tariff concerns, and really the media was actually saying the opposite. The Canadian dollar was going to weaken because the Canadian economy would be in trouble, and lo and behold, the opposite happened. We're now sitting around 74 cents. From a short-term perspective, that's overbought, no doubt about it. I'm not going to go and get super excited about this chart. I do think we want to pay attention to it because this also relates to the whole commodity theme and the value theme and the outperformance of the Toronto stock market, and there's a lot of things. But yesterday, for example, if we're selling US dollar holdings or US dollar gold, for example, we're actually going to hold those US dollars even though this Canadian dollar is breaking higher. Why would we do that? Because in the short term, I think that again, it's extended, and we certainly wouldn't want to go and convert currency at the wrong time either. This is the metals and mining ETF, which again, I think should be on everyone's radar, outperforming both markets for sure. A few days ago, we had the biggest bar against. That to me is a start of a sell-off, not necessarily a sell-off, correct me, more of a correction, right? Now, how that correction looks, we don't know, but the bottom line is this is certainly a group here that is full of everything to do with mining and coal and clean energy even. And so we want to be aware here that when strong groups that start to show impulsive buying start to pull back, we want to kind of add them to our watch list. Again, just to show that this is a market of stocks, not a stock market. The Toronto market, which has been very strong, has got these 4 stocks in it, among many others. These are all 4 stocks that we all owned but for our clients last year. And at some point we sold them, right? We sold them for technical reasons. We sold them for relative strength reasons. We sold them for biggest bar against and so forth. The reason doesn't much matter. What I'm trying to point out here is we've got everything from financials, we've got Thomson Reuters, a couple of tech companies. Look at this, 3 of them are down 40 to 53%. That is harsh. Every stock has the potential to peak, and it has the potential to peak any day. That is how I operate as I sit here and manage money as a portfolio manager. And we want to be always open-minded to that. We never want to get caught up in the narrative or our favorite company, our favorite ticker symbol, because again, we can then have a problem making the right decision when that supply imbalance suddenly changes. Finish off a sector watch this week. There's the energy stocks up at the top of the list, and on the bottom, we've got the consumer staples in Toronto. Again, some of the grocery stores and whatnot have coming down. You can see the the financials, which have also been very strong in Toronto, a little bit of a week off. Not much to say. The market has been strong, no doubt about it. So the excitement we just talked about in gold and silver, it is what it is. We'll see what happens. But again, just be careful. Always suggest kind of some caution, right? Especially when something has gone a long way and has perhaps come a little too far too fast. We are going to be doing an upcoming seminar. This will be a live presentation. It will be recorded. It's going to be on Wednesday, March the 25th, and it is going to be called Living is Giving. Many more details to come. I also hope you read my recent blog post on the InSync angle talking about bubbles. If you haven't, please let us know, and we'd be happy to get that to you as well. Please follow me on X. I'm at David Cox RJ. Thanks again for your time this week. This has been David Cox, Portfolio Manager at Financially InSync in Waterloo, Canada.